Well, congratulations that you made it through the accounting cycle. We've been able to accomplish quite a bit so far. Now we shift our attention from a service-based business, providing a tangible product or good in a merchandising business. Now, here's what we have to remember here when it comes to this particular area of the course. We're really talking about business-to-business transactions. So I will buy inventory to resell to another place for them to sell as well. So we're really not talking about going into a retail store and buying something. So just kind of keep that in mind as we go through this material. So we really have two different types of inventory systems to look at. They are periodic and perpetual. For this course, we will focus on perpetual. But let's define both just so you know what they are. So periodic, when you think of that, you think of every now and then. So we take inventory only really at the end of the month, and we wouldn't keep track of it at all times. Contrast that to perpetual, when you think of perpetual is kind of ongoing or forever. That means that we really would keep an ongoing, constant running total of inventory. So if we wanted to know how much of a certain item that we had, we would be able to look up in the system, see the number of units, as well as the cost basis for that. So just kind of keep that in mind. We're going to really focus on perpetual and really not take any time on periodic here. Now here's some kind of tools for the trade for this chapter and material. What you want to remember here is there are going to be some new accounts. So I recommend that you make note cards for them. And here's probably the most important thing of all. Our accounting cycle does not change just because we're moving from a service-based business to a merchandising business. Okay, so let's do some more background on this. Here are some new accounts that we have. We have a couple slides of those. So the first one, we'll just go from the left to right here. We have merchandise inventory. That will be an asset account with a debit balance. And what you have to think of when you think of merchandise inventory is we're going to go out and acquire something to resell to make our profit. So what we want to try to often think of here is that you want to try to acquire inventory at the lowest cost as possible, because that allows you to then generate more profit on that. Now, probably the biggest expense account a merchandising business has is called cost of goods sold. That is an expense account, part of wire, withdrawals, investments, revenues, and expenses. That'd be expense part. And it also, as an expense, will have a debit balance. You can abbreviate cost of goods sold as COGS, C-O-G-S. That is perfectly acceptable and allowed. We have a seller paying to ship an item out to a customer that they've sold. That would be called freight out expense. Also may see that referred to as delivery expense. So that's another new expense account that we have. And it would also have a debit balance. Now, obviously, we've transitioned from a service-based business to a merchandising-based business, so we don't have service revenue as our primary revenue account anymore. We're going to have sales revenue. So that will be your primary revenue account with a credit balance. Now, we talked about sales revenue on the previous slide. We have to have some mechanisms to be able to allow certain things to occur. Obviously, if someone wants to return something, that's got to be something that we can do for them. And in some cases, we may just give them an allowance, meaning we're just going to give them back their money or reduce the amount of accounts receivable that they owe to us. And then we also may have a situation where we decide to offer a sales discount to our credit customers. So you don't want to think of a sales discount as buying something on clearance or getting something in a store that's been significantly marked down. That is not what we're talking about here, so just kind of keep that in mind. A sales discount will reward our customers that we've extended credit to for paying in a short period of time, and we'll see how this works in a little while. Now, what are sales returns and allowances and sales discounts? Well, they are contra revenue accounts because they are going to act as an opposite of a revenue account. So they will have debit balances. So I would definitely take some time of taking a look at these two previous slides and getting your note cards down so that you can get these accounts understood quickly. A couple other items to look at here. When we think of invoice terms, meaning if you get a bill from somebody and it says something like 215, net 45, that would really reflect that we're getting a 2% discount if paid within 15 days. Otherwise, the full amount is due within 45 days. I always say that really, if you have good purchasing managers and you're buying something and on credit, and they're going to give you an opportunity to get a discount if you pay within a short period of time, you definitely want to take advantage of that because it's going to lower the cost of your inventory. Now, why would someone want to do this? Well, let's think about this for a moment. If I am owed money by my customers and I put out that they'll get a 2% discount if they pay within 15 days, I'm really liking the fact that if customers take advantage of that because I'd much rather get 98% back of what I owe than get 0%. So, and it also allows there to be an infusion of cash coming into the business. So it's a strategy that's great to collect your account receivable quickly. And if you take advantage of that as a customer, then you are getting a slight break on what you're purchasing from them. So it works for both the buyer and the seller pretty effectively. You can see at the top of the slide I wrote about 1.5 net 15. That would be a 1% discount if you pay within 5 days. Otherwise, the full amount is due within 15 days. You may see N/EOM. That means net end of month, meaning you'd have to just pay the full amount by the end of the month. You just may have terms of N30, meaning the full amount's due within 30 days. You can pretty much have any type of terms for an invoice that are, you can dream up. You probably wouldn't really want to go beyond 45 or 60 days because you don't want to have your accounts receivable be outstanding for any longer than that period of time. Okay, then we get to FOB shipping point and FOB destination. This is another part of shipping terms. And basically, we have to look at when does the title transfer of the goods and who pays for shipping. Well, here's the breakdown of this. For FOB shipping point, the buyer pays the shipping, and the buyer owns the goods as soon as they are loaded onto whatever shipping vehicle it is. Truck, plane, car, boat, doesn't matter. So as soon as those goods are loaded onto that delivery vehicle, the buyer is in ownership of those items. So while in transit, if the terms are FOB shipping point, the buyer owns those items. The opposite is true if you have FOB destination. The seller will pay for shipping, and the seller will retain ownership of those goods while in transit, and they will not become property of the buyer until they are offloaded to the buyer's warehouse or final destination. Here's a kind of a list of some things that you need to record in the journal when you think of regular journal entries for perpetual inventory. We have to always kind of keep in mind that the inventory must be constantly updated. And when you think of the new entries, and this isn't an all-inclusive list, it's just some of the primary ones that we'll see, you may have to record, obviously, we purchase merchandise inventory with cash or on account because inventory is coming in. We've got to make sure we keep track of it. Cash is going out or accounts payable is increasing. You may have to return inventory that you purchase with cash or on account. Then we get to selling. Anytime in perpetual inventory when we sell merchandise inventory for cash or on account, you must do two separate journal entries. We have to not only record the sale to the customer, we also have to record the decrease in inventory. So we will have two journal entries to do in that particular case. Same thing is applicable when you think of accepting a return of merchandise inventory sold for cash or on account. Again, 2 journal entries. We have to record the return for the customer as well as the increase in inventory coming back into us. And then we also have to know how to recognize a sales discount on merchandise inventory sold on account. So if we offer a sales discount, how do we record that? And then also, it's not listed here, but another example would be, what if we, as a buyer, took advantage of a discount that was offered to us? So we have quite a few things that we'll see when we think of the different journal entries that we have here for perpetual. Now, when we think of the income statement and the financial statements for the inventory, a merchandising-based business, what you have to remember is that there's going to be a slight difference here. Obviously, we will always include just revenues and expenses, but we do have some different things to look at. We can't forget cost of goods sold and our contra revenue accounts. They will appear there. We have an option. Should we prepare what's called a single step versus a multi-step income statement? I'll definitely, when I do the problem with you, I'll explain how this works. And you really, when you think of multi-step, it's really the primary format that people want to see for merchandising because it gleans more information for the user. And you'll see in the problem that we do later on in another video how this will work itself out. Now, there'll be different categories of expenses. The textbook will tell you where to put them. The different types of expenses are general/administrative and also selling. So you have different options there. When we think of general administrative, these are things that do not directly relate to the selling of the product. You could say, let's say we had a headquarters in Michigan and we had our rent for that. Well, if that's the headquarters, that's not our storefronts. So that wouldn't apply to selling the product. So that would be an administrative or general expense. Whereas if you think of marketing expense or advertising expense, those would be directly related to the selling of the product. So that would fall into the selling category. So the book will tell you, in fact, you may have both. You may have rent expense for both categories. You could have rent expense for a storefront that's selling the product directly, and then also, again, like I said earlier, the rent expense for the headquarters. So you may have some for each category. It just depends. Okay. One other thing that we want to look at here real quick is the closing entry portion of this. I think what you want to remember here is that when you think of closing out revenues, expenses, income summary, and withdrawals, it's the same process, but a couple notes. Sales revenues are primary revenue account now. You may also have other revenue accounts. Examples include interest revenue in this chapter. So just kind of keep that in mind that you have to close out. When we think of expenses, we have to not forget cost of goods sold because that is a huge expense account we can't forget to include here. And we also here have to include our contra revenue accounts, our sales discounts, and our sales returns and allowance accounts. So don't forget that. And then when we get to income summary and withdrawals, it's the same exact format as before. There's no change there. Okay, so let's go ahead and take a look at some problems on these topics in the next several videos.